welcome to the Business Standard Morning Show. I'm Nazia Iqbal, and here's a look at the stories for the day. India's goods exports fell by 6.6% year-on-year in January. It was the third decline in the past 4 months. But the country's trade deficit touched a 12-month low of $17.7 billion in January, which was a relief from last year's July figure of $30 billion. Imports also dipped and contributed to the narrowing of the trade gap. So is this fall in trade deficit a cause for cheer? Bhashwar Kumar brings you the answer.
India's trade deficit narrowed in January, hitting its lowest in a year at $17.75 billion. The moderation in trade deficit came as both merchandise exports and imports contracted for a second straight month. Merchandise exports dropped 6.5% year-on-year to $32.91 billion last month. The reason was a slowdown in demand from key developed economies. The decline was 4.5% on a sequential basis. Imports declined 3.6% year-on-year to $50.66 billion. The government's curbs on non-essential imports, easing commodity prices, and weak domestic demand were behind this decline. At 13%, the decline was sharper on a sequential basis. So, how do experts read this moderation in the trade deficit, and do they think it's a cause for cheer?
See, the fall of the trade deficit, for whatever reason, is always a cause for cheer. And given the fact that this is one of the lowest that we have witnessed in the year, I think it's definitely a positive sign. But I prefer to look at cumulative data rather than single months, because in a single month, we could see certain things happening which cannot be replicated in future. But if you look at the 10-month period, the overall trade deficit has actually gone up around $80 billion. So I think that would still be a concern for us. It's higher than what it was last year. And therefore, I mean, we can be cheerful about the fact that for one particular month, it's come down, but it needs to be sustained, on which we're not quite sure about what direction it will take.
Trade deficit has certainly come down in January, and that is on the back of a steep decline in imports. But that decline in imports is happening only in case of gold and silver, substantially. As long as we see trade deficit declining, there's a cause for cheer in the context of rising current account deficit. But one also has to see the larger picture, which is that between April to January, the trade deficit this financial year, trade deficit is almost double that of the corresponding period last year.
Also, is the moderation in trade deficit a blip, or will it continue?
See, it could be a blip. Actually, it's hard to say at this particular point of time, because the trends always point to exports and imports both coming down. And we've also seen that global commodity prices have eased. India is typically a larger importer than exporter. So as prices come down, there would be a greater benefit for us. And that's one of the reasons why we're seeing the trade deficit narrowing in the month of January. So it could be happening again. On the other hand, given the fact that India is going to be one of the better performing economies, growing at 6.5% next year, the demand for imports is going to continue. So that's why I feel that this trade deficit is going to continue to be under pressure, even in fiscal 24, as imports continue to grow, as the demand for non-oil imports keeps increasing, and exports could be slowing down further on account of the recession in the West.
The trade deficit is also happening because exports are not growing, and exports are not growing because of the global situation. Our export sector being import dependent, or the manufacturing sector as a whole being import dependent, if exports slow down, if the foreign demand slows down, then the manufacturing is also going to slow down. And we are seeing some indications. December, we saw certain concerns about the manufacturing growth. So the manufacturing sector will also slow down, and imports will come down. So I think there'll be a moderate increase in trade deficit going forward, and therefore the current account deficit. But I don't think it's going to be as large.
On 15th of February, Finance Minister Nirmala Sitharaman said that discouraging imports for self-reliance was not a good idea. She added that this was because several MSMEs and large manufacturers needed to import inputs and critical components. With the risks rising on the external demand front, the government is concerned about the current account deficit. This has brought the focus back on curbing non-essential imports like gold, which contributes significantly to the widening CAD. Imports of the yellow metal declined 70.7% to $697 million in January. India's CAD may have reduced in the December quarter. This is because pressure from negative net exports eased during this period. In the September quarter, CAD had touched a 9-year high of 4.4%, rising from 2.2% in the June quarter. Against this backdrop, what do experts have to say?
I see that CAD actually remaining in this region of around 3%. We could actually be crossing the 3% mark for the full year of 2022-23. But next year, there could be a bit more comfort in the sense we could be coming down below 3%. We're looking at a number of between 2.5% to 3% for next year. But it all depends upon the China factor also. And I say China factor is important because today when we say global commodity prices are down, it's one of the reasons is that China was closed for a very long time on account of the zero COVID policy. And today, now that they've opened up, and once China starts entering the market, everything happens in a big manner. There could be an upsurge in terms of commodity prices, in which case I think our imports will get affected more, while even our exports will benefit. But then definitely, I think we could be expecting pressure further on our trade deficit and hence the current account deficit. So therefore, we're looking at a number of around 2.5% to 3% for next year.
In spite of the RBI governor's assurances that the current account deficit is eminently manageable, it may emerge as the primary cause for concern for policymakers in the coming financial year, given how uncertain the trade component is expected to be.
It is not just cross-border trade that is taking a hit due to the global slowdown. World over, companies are also scrambling to maintain their profitability. They are laying off employees to stay afloat. Last week, Disney announced its plan to fire 7,000 employees as the conglomerate restructured the organization. In India, Disney Plus Hotstar has lost the IPL digital rights along with 3.8 million subscribers. So, is Disney Plus Hotstar in trouble here? If so, what is the way out? Tariq Ahmed's report has all the answers. In April of 2020, Disney Plus acquired Hotstar from the Star Group and the streaming platform became Disney Plus Hotstar. It introduced the current subscription-based streaming service in September 2021, providing content across English and 7 regional languages in India, has been the largest subscription-based streaming service in the country. When Disney Plus Hotstar introduced the device-oriented subscription rates emulating Netflix, it had 43.3 million paid subscribers in July-September quarter 2021. The number rose gradually since then. In July-September quarter of 2022, the streaming platform had 61.3 million subscribers, the highest ever. But in the last quarter, that is October-December 2022, the subscribers base of Disney Plus Hotstar fell to 57.5 million. It was a loss of 3.8 million subscribers to the firm. This loss in the subscription is the highest in any quarter. Although Disney Plus Hotstar has services in Indonesia, Malaysia, and Thailand, most of the subscribers are from India. So what led to this drop in the subscription base?
Hotstar as a platform is a market leader, for sports content, and close to 80% of the revenue are cricket driven, within which you can say about 65% is primarily led by IPL. So I think, once they lost the IPL rights last year, after the auction which happened in the month of June, there would be renewals which would see an impact. And I think this is not the worst. I think the worst is still yet to come, because I'm expecting a lot of a drop in the subscription rate even towards the month of April, May, June, because that is the time where people subscribe to these platforms for watching IPL. So my guess is that there has been a decline, but the decline is single digit in nature. I'm expecting that somewhere close to 30% or maybe 35% of the paid subscriber base could actually move away from Disney Plus Hotstar because of IPL not being there.
According to the FICCI EY report, the 2023 IPL edition will have a viewership of 523 million. There is a decline in television-based subscription, and the online streaming is likely to grab a huge share of the IPL viewership.
The real challenge for the platform lies in Q1 and Q2. That's when they have to fill up this major void of not having IPL. Also, from the call that we heard last week, the management as such at a global level is focused on cost efficiency. There are constraints been put on entertainment budgets. So all of these factors give a lesser reason for a lot of those subscribers coming up for renewal during the first half of 2023.
Also, the loss of subscribers for Disney Plus Hotstar was another blow for Disney, which is already facing challenges and is resorting to cost-cutting plans. Disney is planning to cut $5.5 billion in costs and 3.6% of its employees. Globally, Disney faced losses for its streaming services in the last quarter. The losses increased almost 50% to $1.05 billion. The reinstated CEO Bob Iger is making structural changes to revive Disney's fortunes. The company plans to produce more original content to make the streaming platforms, including Disney Plus, profitable. According to media consulting firm Ormax Media, the subscription video on demand or SVOD base in India has increased by 18% in 2022 from the previous year. The Ormax audience report reveals the trends in the viewership. More young audiences are joining the OTT platforms, and both international in English and contents in Hindi and South Indian languages are attracting more subscribers. Although Disney Plus Hotstar has retained the digital rights for ICC events, making more original content will be instrumental for it to retain the subscribers.
I think very important for Hotstar would be, to kind of get a lot of original content in place, a lot of original content, a lot of global shows that they have an expertise upon. They already have a very wide variety of movie catalog. They've got Marvel Studios and they've got their own Disney movies as well. So in terms of movie catalog, I would rate them as one of the richest in terms of catalog. I think the only thing addressable is that 2-3 things. One is, I think, if they are able to retain the BCCI rights for the digital platform which is there, which is upcoming for renewal this year for the India-based matches, that could be a respite, for the platform. And also the second thing is that a lot of these World Cup tournaments are also coming every year. And that also is going to have a positive impact in terms of overall subscription.
Experts believe that a large number of subscribers, led by the IPL, will move away from Disney Plus Hotstar subscription. But the original contents in regional languages and a versatile movie catalog will still attract subscribers to the platform. The initiative at the Disney Global Headquarters to introduce creativity and to come up with original contents should find resonance in India too, which will in a way revive its fortunes for Disney Plus Hotstar. Moving on to the financial markets, the new budget proposal to tax income on high-value insurance policies has raised concerns for insurers, evident from their weakness on the bourses. So how long may the pain continue for the stocks, and can they bear fruit in the long run? Here's Harshida Singh's report.
A A sharp plunge in insurance-related stocks on budget day prompted players like HDFC Life and SBI Life to issue clarifications on the likely impact of the new tax norm for high-value policies. However, this did not help ease investor concerns. Since the budget, shares of HDFC Life, SBI Life, Max Financial and LIC have lost up to 10% so far as compared to a 2% gain in the Nifty 50. Experts say that the government's proposal to tax income from traditional policies with over Rs 5 lakh annual premium and the shift to the new exemption-free tax regime deal a double blow to insurers. The companies, they believe, could see impact on demand in both the masses segment and the high-ticket non-ULIP plans in the affluent segment.
As the new tax regime starts to take shape, and the new tax regime will mean that the old tax regime will get faded in the next 1 or 2 years, the incentive to buy life insurance plus investment products, life insurance plus investment as in ULIPs and all other types of products, goes down and down. And that's a key negative for the life insurers, as life insurance is always sold with the purpose of tax benefit, the first point. The second point is this 5 lakh tax on investments plus on policies where premium is higher than 5 lakhs can also hit the embedded value of life insurers by 5 to 10 to 15%, or depending on the product portfolio of all of these companies.
Analysts say the tax proposal will impact the top-selling par and non-par savings categories the most. The two segments drive around 35 to 60% of the listed company's annual premium equivalent, or APE, and 30 to 65% of the value of new business, that is VNB. As per Jefferies, a 20% lower than estimated mobilization in premium across par and non-par products in FY24 can impact APE by 7 to 13% and VNB by 6 to 15%. The impact is higher for HDFC Life and Max Life, followed by SBI Life, and lower for ICICI Prudential Life. While the overhang on stocks will likely continue in the near term, analysts believe long-term investors can accumulate the stocks amid the current weakness.
So the entire life insurance sector has been undergoing a valuation derating for about 1.5, 2 years. You see, price to embedded value is the metric that we really look at. HDFC Life used to trade at about 4 times price to embedded value. That's come down to 2.5 times. ICICI used to trade about 1.5 times, has come down to one time embedded value. LIC is already seen a derating. It trades much below its embedded value. So the derating process was already on. It has got accelerated by this. And I feel that the valuation should now broadly bottom out from here on. No, insurance is a sunrise sector where penetration of insurance is very, very low in this country. As time really goes on, the insurance sector will get huge penetration. That's not really a problem. Near term, there's a negative for all of these companies where embedded value will get it, or there will be a derating. However, from a long-term perspective, positive on the sector.
While insurance players have sought relief from the government to expand the premium threshold, the street's focus will now be to assess the business loss next fiscal year and the sector's tweaked strategies to offset the impact. That said, equity markets will track their global peers today for direction.
Meanwhile, on global indices, stocks of small artificial intelligence groups have soared in the last few months, thanks to the hype surrounding OpenAI's ChatGPT. No one took artificial intelligence so seriously before ChatGPT happened. It is now inspiring a host of other chatbot innovations. One such chatbot will now help Indians address their Aadhaar-related queries. Raghav Agarwal explains how.
According to IBM, a chatbot is a computer program that uses artificial intelligence and natural language processing to understand customer questions and automate responses to them, simulating human conversation. OpenAI's ChatGPT has set the ball rolling. China and India too have joined the chatbot race now. In India, the Unique Identification Authority of India has launched a chatbot to help people get answers to their queries on Aadhaar. This artificial intelligence and machine learning-based chatbot has been named Aadhaar Mitra. According to UIDAI's website, Aadhaar chatbot is designed to answer queries on Aadhaar-related topics, provide information on how to locate an Aadhaar center, check Aadhaar enrollment or update status, check PVC card order status, file a complaint, check complaint status, locate enrollment center, and book an appointment. Indian residents now do not need to go to an Aadhaar enrollment center to update the card. It can be done through the chatbot. They can also apply for a duplicate Aadhaar if the original is lost. It also shows videos to help the users understand its features and how to use them. You can go to UIDAI's website to use Aadhaar Mitra. Open the chatbot by clicking on the Aadhaar Mitra box in the bottom right of the screen. There, you can enter your question manually or even select the preset query options. The answer will reflect on the screen instantly. There is also an option to give feedback on the Aadhaar Mitra's answers. After every answer given by the Aadhaar chatbot, there is a thumbs up or thumbs down icon below every chat response. Additionally, after the end of the session, people can provide a star rating on a scale of 1 to 5. According to UIDAI, the feedback is analyzed by a team and changes are made to the bot.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Meanwhile, a debate is on whether governments should use ChatGPT or similar products to provide services. Some are of the view that authorities should not use it as chatbots need access to data to deliver services, which may also lead to data breach. Well, that's all for the day. For more news and analysis, please log on to business-standard.com. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.